Going on, Pete?
Hey Connor, how are you?
I'm doing pretty good. So, guys, I want to introduce you to Pete Tredwell today on the Investor Army podcast. He's a great friend of mine, talented investor out of North Texas. We go back quite a while. In fact, we share a commonality where we did our very first deal together. That's why it's a special day for me to introduce him. He's a great guy to learn from, and we're going to kind of go into who he is and what he's done and how he can help you. So, Pete, go ahead and give everybody listening today kind of a rundown of who you are and how you kind of got into real estate.
Well, sure, Connor. I always had an interest in real estate and flipped my first house in 2004, 5. It was a house that I bought as a fixer-upper to live in after I got married, and had such a great time doing it. I always thought it would be fun to do full time, and kind of dabbled in a little bit for a while. And I always had good jobs, though. I worked at ESPN for 10, 11 years back in Connecticut, and then took a job down here in North Texas running marketing communications for a $40 million nonprofit. Made real good money doing that, and got laid off, got caught up in the corporate restructuring of that company, that was the time when I knew it was time to get into real estate full time. That was several years ago, and that's when you and I met, and ever since then, it's been a fun ride. It's great life living the real estate investor life.
Yeah, so we both, I guess, kind of share the same thing. We both once had a job, and we kind of learned how vulnerable a job is, and so we wanted to kind of take control of our life and know that we are now in control and not someone else, that we can wake up one day and they kind of cut the floor out from underneath us. So I want you to kind of talk about how we did our very first deal. So something special. Very rarely do I get to talk with someone that I actually did my first deal with. You're my first, Pete. You're my only one. So you're the only one that can ever say that. So
never forget the first time, right?
Right. I worked really, really, really hard to get to that first deal, and it was really small for me. I think you did a little bit better. So kind of quickly how it happened was I found another property from another wholesaler, and I basically presented this property to Pete. So it was kind of a joint venture wholesale deal, and Pete had some money from a friend of his that was willing to invest at a pretty good interest rate, and he decided he was going to go and rehab the property. And we're going to kind of talk about this property a little bit because it's going to play into like the topic today, which is going into secondary markets. So can you kind of tell them a little bit about how that deal went down?
Yeah, sure. Connor, North Texas is an extremely competitive market, as you know, for real estate investors. I mean, you could make the case that it's the most popular investor market in terms of saturation of real estate investors, both new investors and experienced investors. And I was, when I was getting into this full time, I was, trying to compete with some of these big sharks in the area, and it was tough. It was real tough competition, and so I was doing my marketing in the main areas of North Texas, and not doing so great at first, and you presented me with this deal that was outside the area, and of course my first reaction was probably the same as what most people would say. Oh, man, I'm not going there. That's too far. I'm not going up there. And, and then I thought to myself, you know what the heck else is going on? I mean, why not give this a shot? And so I took the deal, went ahead and did the deal. And while I was in the process of closing that transaction, I put some marketing out in that area and found 3 other deals. And I bought 4 houses that first week that I closed on that house. And the key was the things that worked that didn't work in the primary market were working way better in the secondary market because there was just less competition with investors. The houses were cheaper, easier, less barriers to entry, and there was just a much greater chance for success. And I've been those secondary markets ever since. It's been a real key to my success.
Okay, that's some good information. So let me recap on all that for y'all. So a secondary market, for those of y'all who are newer in the business, is so most of the major cities, the big metroplex areas, they're going to have large amounts of training companies and gurus coming through these areas. You're going to have a lot of meetup groups. And so what happens is they're not going to spend the money to travel around these small areas because it's not going to give them the return on their dollar. So you don't have these meetup groups. You don't have the education in these areas. A lot of times the investors you're competing against are kind of mom and pop investors that, built their portfolios over the long term with 1 and 2 deals here and there, onesies, twosies through referral types of deals. Also, you're going to have not as many jobs and not as much money because everything is, as you get closer to the main heart of the city, there's more opportunity. So as you move out, these people don't have this type of opportunity. And a lot of times they don't have as much money. When people don't have as much money or as high as an education level, they have less exits to get out of the deal. So if you're in an area where people have high income and high education level, they have more ability to refinance with the bank, get loan modifications, have family members come and bail them out. So there's a lot of opportunities in these secondary markets. And the big problem with new investors, including myself, why it took me so long to do a deal is because I didn't want to go outside my own area. But if you can travel 1 hour to a different market and increase your income by 20, 30 fold, which some people are doing, it's definitely worth it. So Pete made a smart move and I quickly followed because I realized that, hey, he's up there doing all these deals. We're struggling here in a tough market. Why not take the time to move up there? But even when you're doing deals, there can be problems. And so Pete learned this early on with actually a house I sold him. So he probably secretly doesn't like me for that. But I sold him a big house. And one of the big problems I see with a lot of new rehabbers is dealing with contractors. Now, Pete has an interesting story on one of his that hopefully he can share some of his wisdom from the business of actually living it, that he can help you avoid getting into some of these troubles. So you want to tell him about the Belden property, Pete?
Yeah, sure. It wasn't one of my proudest projects. It was an awesome project. I mean, it looks beautiful. The end product was awesome. It was a 100-year-old traditional New England colonial that needed a full rehab. 3,200 square feet and needed basically everything. There were people living there, which is always one of my standards for how much work does it need, but it needed a ton of work. And so I had just kind of gone separate ways with a previous contractor. So I was already on the defensive, looking at new contractors, but being skeptical and cynical of who I was going to be working with. So I got connected with a guy who I felt like was going to be, solid and had good skills, good reviews, good recommendations. And we worked out a plan where, he laid out what his rehab timeline was going to be at each date. He's going to do this project the first week, this the second. It was like about a 2.5 month rehab. And, he was going to, we're going to pay this much at this point after he orders this, after he completes, this part of the project. And well, as it turns out, a lot of the stuff that happens at the end of a project is the expensive stuff. In this case, hardwood floors and granite and windows, stuff that kind of happens at the very end. That's really expensive stuff, but it has to be ordered earlier in the project, like halfway through the project, so it's ready to go at the very end. Well, as it turns out, he didn't order those things. And I'm paying him as we're going through as if he did order those things. And so as it turns out, he was running out. He had underbid the project, and he was running out of money. And it got to the end of the project, and I still had granite and flooring and windows and some other things that needed to be done. And I'm thinking we're going on the market in a couple of weeks when all this stuff gets put in, and he's out of money and hasn't ordered that stuff yet. And I tell you what, that's not a lesson you ever forget, and how to deal with contractors, how to hire contractors, how to negotiate deals with contractors. And you could talk to whatever experts you want, but there is no lesson like the lesson taught to you in a situation like that.
Yeah. So what happens when you get to the end of the project and you've already done a big mistake, like so many of us, including myself, has done, and you pay out a contractor in full, and you're trusting that he's paying the subcontractors? What happens then? Well, they can't finish the job. Some contractors need to get paid. They've promised to pay them. They have no more money. And what happens next? Your phone starts ringing for subcontractors wanting to get paid by you because you're the homeowner. And what's the next thing that comes out of their mouth? I'm going to put a lien on your property. So really, now you're in a tough spot. Now, what are you going to do? Can you go you can go win a judgment on the contractor, but what are you going to do? Put it on his $1,000 truck that he probably doesn't even own anyways? So you get stuck in a tough spot, and there's a lot of different ways to work with these contractors. And so far, most of them, are still going to give you headaches no matter which way you go. So it's kind of, you have to do what's best for your business, but not everything's going to work for someone that works for another person. But you ended up getting into a situation where this guy cost you what, tens of thousands of dollars.
Yep.
And fortunately, the house had appreciated some, and you did a good job marketing it, and you were able to find a buyer, an all cash buyer, and you got out of it okay. But even though you made a small profit, what was it, like 15 grand, but you thought you were going to make 60 or 70. So really, it didn't turn out the way you wanted it.
Yeah, it didn't end the way I wanted to, but it's a beautiful house, something I was really proud of. I mean, and you can't, like I said before, you can't really beat the lessons learned from going through a process like that. And now when I deal with contractors, the red flags to look for, the payment schedules to set up, the questions to ask in advance, because once you've had those issues, you'll know you'll never deal with that again. And, so it was a lesson learned, and I'm a better investor for having gone through it. No question about it.
Yeah. And like, if you're ahead of them in payments and it doesn't look like it's getting done, you just can't pay them. You just can't pay a contractor before the work's done, because
no matter what they say,
no matter how much they whine or complain or say, I can't pay my guys. Well, too bad. The reason why you can't pay them and they don't deserve to get paid is because they're not finished. And so if you give that last check, they can run off, and they will. They have no loyalty to you. Not all of them are bad, but I've dealt with a lot of bad ones. And the other thing is, you don't want to give a big amount up front. Like, they're going to ask you, say they need 50% up front to start the project.
For materials.
For materials. And their first week of labor. I pay them by the week. We look at things as we go through, because if you let them get ahead of you, it's rare that they're going to get caught up. And then here's the thing. If they don't have a few $1,000s in the bank to cover the materials at the start of a job, what kind of businessman is this guy? You should be paying for projects completed. And I don't mind. That doesn't mean waiting until a $50,000 rehab is done and paying him $50,000 after he turns over the keys to you. It's not that extreme, but he shouldn't be asking for money on day one and saying he has to buy materials, because he should have a few $1,000s in the bank to cover that, and then you pay him at the end of a set period when certain projects are completed. That's different, and I think that's okay. But you shouldn't be paying up front on day one. That's a really good point. Like, if they're not capable enough to manage their own life to where they can have a little bit of money in the bank to run their own business, are they really someone you could trust to manage $50,000 rehab on one of your properties? So just be careful with these contractors. Now, one of the things, because of you having so much headache with contractors, is something that I do quite a bit, which is kind of a prehabbing type of mix between a rehab and kind of getting the property ready. Sometimes we prehab them and list them. Sometimes we prehab them and sell them on our own.
Some people call it wholesaling.
Wholesaling. Well, yeah, you can, yeah. So like, what is it? So you've been, over the past year, 18 months or so, you've kind of switched your business model to getting away from a lot of full retail ready, from beginning to start, sell it to the end buyer, retail buyer, to kind of prehabbing houses, selling them to investors that come and finish them out. So you're using more time efficiency, but you're making roughly the same profit with a smaller amount of time invested and a lot of less amount of emotional capital to do these deals, right?
Yeah, I think prehabbing, if you have the capital to close on the deals, I think prehabbing might be the best strategy going right now. And I completely agree with you. Here's the way I look at it. If you have let's just say a $30,000 rehab, okay, on a house, the first third, meaning the first $10,000 and the last $10,000 are what makes you the most money. Okay, so if you spend that first $10,000, man, we got a leaky roof, we got junk everywhere, and I've got countertops that are split in two, and there's a hole in the bathroom floor. Well, if you fix the most obvious stuff first, that first $10,000, that's what's, and then you get, so essentially the buyer looks at this and says, okay, all this, there's no scary stuff in here. If I finish that initial part, and then you still sell it as a fixer-upper, because you still have that $20,000 left. And then, but then if you do the next 10,000, it's still a fixer-upper because you haven't finished the rehab. It's that last 10,000 that's going to get you that full retail price. So, and my strategy, I think, like you to a certain extent, is to do that initial. Sometimes it can be as little as $2,000, $3,000, or $5,000 up front, and then sell it as a fixer-upper to other investors or maybe a handy owner occupant. And essentially, you're getting paid not only for the marketing, but you essentially bring in those buyers that are going to be scared by that hole in the drywall, which is super easy to fix. Or, maybe you put another layer of shingles up there, or you clear out the junk in the spare room that people don't want to deal with. And I think that has been a real find for me. And I've done several of those properties this past year.
Yeah, and so like similar to kind of what I'm doing. So we're taking these old frame houses, these little 2-bedroom, 1-bath, 3-1 frame houses, where every house in the neighborhood's kind of run down, beat up. And we're going through and we're putting new siding and a new roof on them. And we're actually basically wholesaling them. We're prehab, I call it prehab buying a list, and we put them on the MLS. So we're eliminating a lot of the risk, because from what I've found in my own business is the riskiest time of a rehab is the day-to-day repetitive stuff that goes on if they can't match the drywall or they mess up on the inside. Whereas if you're paying people just to come and put a roof on or come in and do the foundation, do the scary stuff like you were talking about, these are more kind of solidified, reputable, and credible companies that have insurance. You're calling them, that's all they do. So you're coming in and doing the big ticket items. The risk is these day-to-day handymen. That
middle 10,000.
Yeah, that they just, that every single one of them, guys, is going to tell you, oh, I can do drywall, I can do tile, I can do everything, because they're trying to get their foot in the door to do your project. So if they tell you, oh, no, I can do only this and I can't do this very well, are you going to hire them? And so they get in and you hire them on good faith that they can do what they say they can do. And now they're in there and now you have a contract with them. Now they can't do it. And now you're the one that's going to take the negative hit on it.
Yeah.
So prehabbing is a good idea to do. There's a lot of money to be made in it. It's a little bit less risky. I'm sure you're going to be hearing more about this coming up over the coming months. But let's go ahead. So we kind of heard about Belden. I don't know. Is that your worst deal that you think you've ever had, or?
Yeah, I would say so. Just because of the scope of it, 3,200 square feet was a big one, and I mean it was even at the beginning was the $80,000 rehab. It kind of expanded a little bit more, obviously, but that was a pretty rough one.
I got you on that one.
That's all right, man. It wasn't anything you did.
So, what was your best deal? Go ahead and tell us like an example. Give us one of your best deals, and then kind of like the type of profits that people can expect, and some of the numbers on some of these types of prehab deals that you're doing.
Well, I'm going to throw you a curveball and say my best deal wasn't one where I made the most money, and I'll tell you why. Okay, it was the one where I spent the least amount of resources. So essentially, the profit per hour spent on the property was the best. And it could have been a flip, it could have been a retail flip, but I didn't. I sold it before I did it, and I'll tell you how I did it. It was the hoarder house. You went to that hoarder house.
I wanted to buy that house, and you sold it to someone else.
Yeah, that's right. And and I was fully prepared to do a flip. I estimated it was probably somewhere in the $65,000 to $80,000 range. You couldn't even see the walls, so it was hard to really tell how much it needed. But I knew it needed all the structural, the foundation, windows, HVAC, probably electrical and plumbing. Roof looked okay, but all cosmetics. Obviously, the property itself was a disaster. But it had all the bones of it. 322 brick, 3-bedroom, 2-bath, 2-car garage, brick house, 3/4 of an acre. Cul-de-sac, nice neighborhood. It had all the makings. And, I estimated the ARV at about $150,000. And I was able to, based on the fact that the seller was extremely motivated, like the electric was about to be shut off any day now, kind of motivated. And that's always your best kind of seller, I showed her what my rehab budget was. Obviously on the high end, I'm looking at $75,000, $80,000. And you got to be conservative because there's going to be surprises in every rehab. And I negotiated a price of $25,000. And so I got the property under contract for $25,000 with every expectation that I was going to flip this house and hopefully make, in the $40,000 range. You aim for 20% of ARV. This would have been a little higher than that, so it was still a good deal. And then I remembered as I was leaving the house, I remembered I'd spoken with another investor. So I always learned, you never throw away a phone number. Always put that phone number in your phone. So I called him. I searched Hoarder in my contacts to remember who it was, and I called him, and I told him what property I had under contract, and I said, and he asked me. I gave him the profile, and I told him the address, and he said he would go take a look at it. And that night he called me back and said, "I want the house. How much?" And I hadn't even really given it much thought because I wasn't that serious about selling it. I was going to do it myself. And I said, anyway, long story short, we negotiated a price of $53,000. I was a little leery of assigning the contract at that price point. So I told him that I was going to close on the property, use my cash to close on the property, and then I would sell it to him. And we put it under contract. So literally I owned the house for 2 weeks. I never stepped foot in the property while I owned it for those 2 weeks. And I was able to gross profit $28,000, and probably with insurance, taxes, and closing costs, I cleared about $26,500. And I didn't even send it out to my buyer's list. That was probably my best deal from this past year. Not the most profitable, but the best deal.
Yeah, and so like, technically, for a lot of you who are new in the business, you could have assigned that contract, but kind of the background, I'm sure why he did it was because obviously when you buy a house from someone for $25,000 and you're selling it for more than what they, and so you're going to get profit more than they are off the house. When you double close, or when you close on the property yourself, or if you did what's called a double close, simultaneous close, double escrow, and which is a different type of wholesale deal than assignment of contract, you kind of shield from the homeowner how much you're making, because what happens if she comes to closing and sees what's this number here, this $28,000 that Pete's making, and she may get upset? What happens if she won't sign the contract? What happens if she backs out closing?
I didn't want to take that risk.
And plus, you just, why would you put, even if she's okay with it, it's still not going to make her feel too good about it, and so you just kind of protect her on an emotional level as well. So, yeah. So he did really well on that one. I actually didn't know he had the house, and what I tell you, I was like, if he backs out, I'll buy the house. And so that guy had 1 day to buy it, and I call him, Pete, is he backing out? I'll buy this house.
It was a good deal, wasn't it?
It was a good deal, but like, guys, to tell me that you can't buy a house, so what is, I don't know, they're gonna make fun of my math, but $25,000 into $150,000 is what,
6 times. That's six. It goes in 6 times. 15,
17% like that. So people that tell me you can't buy these deals, this is in Dallas, Texas. They just named it nationally the #1 spot to buy houses right now. That's why so many people are coming in. I get people calling us to join our buyers list from Canada, Australia, all around the country. We got Asian companies coming in, huge private equity and hedge funds, and Pete's able to pick up a house under 20 cents on the dollar. So there's plenty of deals out there. There's plenty of good deals. You're just not doing the right things to get to them. So as we go from 2013, 14, 15, 16, 17, as more investors are coming into the market, inventory levels are getting tighter, deals are getting tougher to find. What do you think is going to be one of the best strategies, or a couple strategies, for some of these new investors that are going to be trying to find deals in their markets all around the country in 2017?
Well, I mean, obviously we've already touched on the fact is getting into secondary markets, where you're going to reduce the amount of competition. I mean, that goes without saying. You have to be on top of what some of the trends are in media, in terms of video. You see right here, you're watching a video right now, in terms of how you can reach potentially sellers and buyers, both through digital platforms, whether it be social media, whether it be your website. You want to automate your systems as best you can. Facebook is an interesting platform, and I think the consensus is that you can't find sellers through Facebook. You know what? That deal, that hoarder house, I found that seller through Facebook. Okay, and you just have to understand what it needs to do, and understand what you do with marketing, and that's connecting with sellers. And I think I've broken the code on that. But I think it's more than just sending direct mail to landlords, which is kind of level 1 of marketing that can work in some of those secondary markets, but it's not going to work forever, and you got to be looking beyond that.
Yeah. So guys, the problem is with a lot of y'all who are new in business and you're starting out marketing is you're just not either doing enough volume or you're not doing it consistently enough. Like we just had the Super Bowl. And what do you see on the Super Bowl? You see Budweiser, you see Coke, you see some of these companies that why would they possibly be advertising? They've been around for forever. Everybody knows them. But why would they advertise still and spend that type of money? It's because of being on front of mind. And a good example is, so like there's this Rotella Velveeta like cheese dip that everybody eats on the Super Bowl. I hadn't eaten it forever. And it was just out of the front of my mind. And when they ran the commercial, I was like, oh man, we're getting that. And so we went out and got it. So I own a lot of houses, right? And so when people mail me, how often do I see them mail me more than once? Rarely. And so the people that mail me twice or three times, I'm like, well, okay, I'm recognizing this guy more and more. And so if you spend $1,000 on a mail campaign and you get no calls, it's tough to pull that trigger and send it out again and again and again because you're not getting leads. What happens if you're just wasting your money is what it feels like. But if you're not building kind of a following, like a rapport through repeat marketing to these same sellers, they're not going to call you when it comes time to sell the house. A lot of times they're saving your information. You're getting calls a year later or 6 months later, like we usually do. You know, like if you're doing Facebook or direct mail or whatever you're doing, and you're doing a small sample size, you're probably not doing enough to really draw leads in like you should be. So I would take whatever you're doing and probably do it on a higher volume and take a little bit more chance with your marketing, because that's what brings you the deals and that's what makes you money. Because if you're not, this is a marketing business, and if you're not doing marketing, you're not making money.
Well, I think I want to touch on that. It's a great point. I mean, I've always said that 75% of this business is marketing. And, you know, there's a saying in the marketing industry, not just real estate, but there's a saying in the marketing industry that in order to get someone to make the buy, to pick up that phone and make the purchase or the sale, that you have to touch them in 7 different ways or 7 different times. So if you think you're just going to send one postcard to someone and they're just going to pick up the phone and they're going to call you, and if they don't call you, that means they're not interested. It's just it's not that way. You got to keep hitting them from different sides, from different angles, and you got to keep doing it. It's frustrating when you're looking to close deals, but don't forget the margin on this deal. If you're spending, you know, I'd say 75 cents is a good number for a direct mail unit. If you're sending 75 cents a unit, think about the amount of margin on each deal you close. I mean, at minimum, it's in the thousands. At minimum. So, I mean, it could be in the tens of thousands very easily. And so if you hit someone, you know, 10 different times, then you spent $7.50 on that marketing to that person. So, you know, you just gotta, I know it can be frustrating at times, but if you know the right strategies to use in marketing to these potential sellers, you can reduce that number from 10 to them never even calling you to maybe they'll call you back in 2 or 3 times.
Yeah, so let's just kind of like break it down. So like if you find a neighborhood that say you're a landlord investor and you're really looking to buy properties that you want to keep for long-term income, cash flow, build your retirement up, and you're mailing on, you know, say you're doing letters or whatever for 50 cents. Postcards usually about 40 cents. Letters are a little bit more. So let's just use 50 cents for easy math. And you're mailing them every quarter, right? And you do that 4 times a year, $2, right? You can mail that person. So if they're an out-of-state landlord that owns multiple properties, eventually they're going to sell those houses. Most people own a house, you hear 7 to 9 years before they sell it. So you're $2 a year, right? 10 years is $20. 20 years is $40. 30 years is $60. So each house you can mail for like the rest of their life. Sometime during that time period, they're going to sell the house. So you're putting $60 towards a single house. If you get that house and your average flip profit's $25,000, I mean, it's
the math works.
I mean,
the math works. There's one particular direct mail campaign that I use, and I try different things in direct mail. It's probably my most successful strategy. You know, a basic campaign that I use, and there's one particular campaign that I use that I have gotten as high as 10% response. I mean, that's unheard of in direct mail. I mean, it doesn't happen every time, but I was getting like a 9 to 10% rate on response. And when you're talking about the dollars you're spending, I mean, you don't have to close that many deals to make that a worthwhile campaign.
Yeah, and he got those because he was going outside a competitive market, and he was going to small markets.
You're not getting 10% in the primary markets for sure.
Yeah. It's just it's just simple. If you have a lot of people marketing the same house, And also the thing is, when you have more people marketing the same house, it's the same problem you have on the MLS. There's a lot of buyers looking at these properties, so the properties get pushed up on how much you can buy them as far as a percentage of market value. So when you get out there and you're the only one talking to these sellers, and they don't have, someone else to call you and play the leveling game and drive the price up, you can get a better price because now they don't really have anybody else to sell it to. So that's why, hopefully y'all took some advice on going outside your market. And if you have to drive, and how far does it take you? An hour to get up there to where we're
about an hour each way. Yeah. Maybe even a little bit more, hour and 15. But, think about it. I'm not up there every day. I'm up there twice a week, maybe 3 times on a busy week. And so just think about it. If you were driving a half hour each way every day, you're about the same amount of time in the car. I'm up there for the full day, and and I got a list of appointments or projects or checking in on rehabs or maybe meeting with a seller or two. And it amazes me how many people dismiss it immediately. Oh, I'm not going down there. That's too far. Okay, well, you can keep beating your head against the wall in the primary markets, and I'll keep making the money. How about that?
Yeah, it's a mindset thing. It's that, the new investor follows the path of least resistance. They don't want to work hard. They don't want to go. They'll do 90% of what it takes to get there. So most investors will do 90%. It's those that will go the little extra bit that make all the money. So just putting in that little bit of extra effort increases your income. You can go up, and you should still be looking in your backyard. We're not saying don't look in your backyard. You should definitely still be marketing in your local area. But if you have areas that you can get to with relative ease and it's not that much more effort to get out there, there may be more opportunity. And so, you may want to look into that. So kind of what are some of your goals that you have for 2017? And then we'll give give everybody your contact information so they know how to reach you.
Yeah, I think I'm probably unique in one respect in terms of real estate investors. I'm a very realistic guy. I love my life. I love being a real estate investor. I love the freedom it provides me. And I don't mean that just for making money, but I mean in terms of making my own decisions and being rewarded for smart decisions. I don't have to rely on a boss to promote me or anything like that or give me a raise. So, my goals are last year I made more than I did in my corporate life before, and I was making definitely into the 6 figures. Okay, so I'd like to up that, from, let's just say, maybe 200,000 to 300,000 next year. I think that's a good goal. I think that it's the people who have set goals of, I'm going to quit my job and not have to work ever again, even in real estate, in like a year or 2 years, or move to the Caribbean in 6 months. Or you have to set reasonable goals. Okay, you aren't successful in this business by swinging for the fences at every time up. You win this business by hitting singles and doubles. And I love what I do, so I'm happy hitting singles and doubles. And and so if I can increase my income a little bit, make a little better life for my wife and kids, then I'm a happy man.
Yeah. So having realistic expectations is really important. So I tell people all the time, this is not a get-rich-quick business. This is a get-rich business. Now, you can do it quickly, and Pete's actually done it, and a lot of people I know have done it real quick. But it's not like you're going to just, in 1 year, be a multimillionaire. So, when Pete's able to talk about making a few $100,000, that's his gross net, or that's his net income. But he's not talking about the equity in his houses or the cash flow coming in. So he's also... I think he's got 8 or 9 properties. So we talked about this a lot last year, is keeping more properties, right? So whatever your business model is, whether you're making big money from flipping houses or quick checks from wholesaling houses, yes, your income's good, but you're working a job. And the only way you're going to get out and have that time to go on these cruises and go around the country and travel with your family and do what you want with your life is to create passive income. And how you can do that, you either have to have rental properties that create notes, owner finance notes. And so Pete, I think, kept 8 or 9 houses last year as well. And when you have an average equity position of $20,000, $30,000 in these houses, and your cash flow's coming in, you can see how quickly you can build up generational wealth. And so it doesn't take a few years of buying 10, 15 houses a year and keeping these houses to really basically set yourself in a position where you're financially free to where you basically can do whatever you want with your life. So Pete, it was a good conversation. I'm glad, you could come on here, take some time. I know you're a busy guy, go ahead and tell everybody if they want to talk to you. I know that you got a lot of students in the area, and that you help, and some people may be interested in talking to you about this. Go ahead and give them your contact information.
Yeah, I'm really good. Email is the best way to reach me. I'm really good about checking it. I'm on my phone a little bit more than probably my wife would prefer. But I'm a hard worker. But send me an email. It's pete.treadwell, Tredwell. Let me give you a different email address. How about this? This is the one that's going to go directly to me. Goes right to my iPhone. Pete@strikefirstproperties.com. Pete@strikefirstproperties.com. That goes right to my iPhone, and I'm going to get it immediately. So, and I'll get you a response right away if you're interested in learning a little bit more about what I do and maybe working with me.
That just shows how smart Pete is, because a lot of people are so desperate just to throw their phone number out when they come on, and Pete knows what happens if he puts his phone number out there. His phones are going to blow up, and then he's going to have to answer these calls. So this way, guys, you want to screen your calls a little bit better. So by going to email, you can contact them that way. But I'll go ahead and make it easy for you to reach him. We'll put his email address and down underneath this video. But thanks again, Pete, for coming on. Keep doing what you're doing. You're doing great up there. And until next time.
All right. Take care, Connor. Thank you.
All right. Have a great day.
All right.